Anuj Jhunjhunwala is the director and CFO now joining in to talk a little bit more about the business. Thanks so much for taking time out. Wanted to talk about the industry as a whole because it seems like the chemical companies are seeing pretty strong demand trends, in particular for the tire industry. Give us a sense as to what it's looking like for the industry and for JG Chemicals in particular.
Sure. Thanks so much for having us on the show this morning. So talking about the industry, you see, the chemical industry in India is poised for good growth. And we make a product called zinc oxide, and that has various applications, right, from tires, cosmetics, pharmaceuticals, paints, electronics, etc. So overall, we see that the demand from most of our consumer segments is growing fairly well. And with the Make in India theme and the China Plus One theme, we are seeing robust demand, which is coming in from our customers as they are also seeing a lot of demand from their end consumer segments. So overall, we are fairly positive on the demand outlook for our industry going forward.
And today, of course, we did see that the listing and it was a little bit tempered. But what is the long-term outlook in terms of your Capex plans for BDG oxides? What do you expect over the next 2 to 3 years? What are the kind of timelines that you're looking at?
Sure. So as we've outlined in our prospectus, you see, we are looking at growing our business multifold in the next few years, and we have a multi-pronged growth strategy. So the first thing that we're looking to do is now have a plant in Gujarat, because Gujarat is one of the biggest consumer segments for ceramics, which is a large buyer of zinc oxide, and plus we have a lot of tire companies there. We're also looking at putting up a plant in Southeast Asia, either through an acquisition or through a greenfield. Southeast Asia is one of the biggest tire producing regions in the world today. We're also looking at diversifying our zinc chemicals portfolio and getting into certain value-added chemicals used in the electronics segment, used in the battery segment, used in the oil and gas segment. Plus, along with that, we are also expanding our agriculture-based products, which we intend to do, and look at various other niche products which we can get into to expand the product portfolio for the rubber industry. So overall, in the last 3 years, we've almost doubled our revenues in the last 3 years. And in the next 3 years also, we would definitely want to overshoot that, given the various new geographies and the products that we're entering into.
Business is completely dependent on sale of one product, that's I think zinc oxide. Are you looking to diversify towards other products, any new substitutes that you are looking at mulling?
So as I said, we about 98% of our sales currently is from zinc oxide, but with the 2 new geographies that we're entering into, which is Gujarat and Southeast Asia, we're tapping completely different markets. And obviously, as a company, we are getting into more products. Last year, we got into a product called zinc sulfate. We're also looking at getting into active zinc oxide, which is a different type of zinc oxide, and various other zinc-based micronutrients and other products for the tire industry, whether it's a niche rubber chemical or reclaimed rubber. Basically expand our bouquet for the existing customers.
What about your revenues and margins from 11% in FY21 to 6% in the current year? That's seen a bit of a decline. We're aware of the issues that you faced in the chemical industry, the inventory build-up, China dumping. Tell me, where do you actually see a meaningful recovery coming in? And if you could just put a timeline to that, or even highlight where things stand as of now.
Sure. So the first thing I'd like to clarify that there's no China dumping angle in our business. There are many chemical companies and chemical products which have a China angle in terms of dumping. Our product does not mainly get imported from China, so there's no China dumping issue. On the margins front, as you know, last 3 years our EBITDA margins have been in the range of 10 to 11%, and we expect that margin to sustain or probably increase a few basis points going forward. H1 this year, we had a bit of an issue because of the sudden and steep fall in zinc prices. As you know, we carry an inventory of about 40 to 50 days, and there was a hit on the inventory valuation, and that is the reason why H1 numbers were weak. On Q3, the numbers were more or less back to normal in terms of the margins that we enjoy, and we expect that Q1 would remain the same. So going forward, unless there's a major swing in the commodity prices over a very, very short term towards the downtrend, we don't see any major impact on the margins going forward. In fact, with operating leverage and economies of scale, we definitely expect the margins to expand. And as you know, we recently got the GMP certification as well, which will increase the sale of a pharmaceutical grade zinc oxide, which obviously has higher EBITDA margins.
Good to have you on board. Thank you so much for telling us a little bit more about your long-term plans and how the China Plus One theme is working out in favor for the company.